All right, what is going on, everybody? Welcome back to another video. We are back again, and today we are going to be discussing risk management and how leverage plays into that. So part of this is going to be risk management, which has to relate to your position sizing and things like that. And then the other part of the video is going to be strategies that you can use when employing leverage or when you decide to use leverage for your positions, and basically how to mitigate risk and open up positions the proper way instead of just jumping in with a whole bunch of leverage with one entry and, kind of screwing the pooch if the price action goes against you. This is going to prevent your risk to reward ratio from getting completely blown out of proportion. And in general, I think this is a topic that a lot of people either skip over completely or is really just forgotten about. This is kind of like my own secret trading technique that I use when I do trade with leverage. You guys know that when I post public trades, whether it's on Twitter or in our Discord, link for that is down in the description below, by the way. Usually it is something that I use quite often, but a lot of people, especially newer traders, try to jump into using leverage because they think that it's a one-way street. They're going to make tons of money with it, when actually, when it's not utilized properly, it can actually be quite the opposite. So today we're going to go over my own strategy and technique, how I employ leverage the proper way, and how you can do this yourself at home or whatever, however you trade, and just kind of have some different techniques available to you. This is mostly going to be a talking head video. There will be some cut scenes where I show the actual platform and different things that you can monitor while using these techniques, just to kind of make it a little easier for you. So I hope that you guys enjoy the video. Make sure that you smash that like and subscribe button and help me out with the algo. And let's go ahead and get right into it. Before that, this video is sponsored by BingX, an industry-leading top-notch exchange for both beginners and advanced traders. Whether you're trading from home or on the go, they feature copy trading, spot, perpetual, and coin margin pairings on hundreds of listings, and an intuitive interface making it easy to place orders and track your positions. Use the link in the description below to earn up to a $4,000 deposit bonus and get started trading today. Now, before we go ahead and get into the meat and potatoes of this video, I want to preface by letting you guys know that yes, I understand that there's a lot of debate around whether or not to be using leverage at all. I know that there's a lot of debate around exchanges that offer more than 20x leverage, and 20x is already a pretty ridiculous amount of leverage if you ask me. So I do understand all of that. This is going to be more geared towards newer traders that just want to pop that, 100x leverage button and slam the slider all the way over to the right and just jack up their position as much as possible because they think that they're going to end up taking a $1,000 account to a $10,000 account or $1 million account within a matter of a couple days or a week or a month or whatever. Just sliding up the leverage is not going to just make your account go up only. Okay, that's not how this works. Leverage should only ever be used as a tool if you are already in a winning position, and we're going to get into that in just a minute. Now, I mentioned newer traders with smaller accounts, maybe $1,000 to $5,000 accounts. Most of those people are going to be wanting to utilize leverage so that they can make bigger gains faster and take their account from 4 figures to 5 figures in a lot shorter of a period of time. I'm not hating on that. I've done that myself. I've used challenge accounts and started with as little as $500 and worked them up to, $5,000, $10,000, $20,000. So I'm not saying that it's impossible, but you also have to realize that I've been trading for 10 or 12 years. So for me, it's a lot easier to be able to do something like that because I have a very solid risk management strategy. That kind of leads us into our first topic, which actually is the whole risk management thing. Okay. So normally risk management, in my opinion, is really going to be decided by your actual account. Now, obviously, this is going to be different for everybody. Some people are going to be able to start with a $10,000 account. Some people are only going to be able to start with a $1,000 account. And you're going to have to judge this for yourself based on what your portfolio size is. But no matter what your portfolio size is or however much you're planning on starting with, please follow the golden rule of trading, which is you never deposit more into your account than you can afford to lose, especially when starting a new account. Okay, so let's just get that out of the way. If you're a new trader, you've never traded crypto before, or you only have a year's worth of trading experience, maybe 2 years or less, don't be putting $10,000 into your account when you may need that money for a car payment or you need it for rent or whatever. Don't do that. Don't bet the life savings on it, especially if you're trading crypto. It's a very risky environment, especially with the topic today, which is talking about leverage. Newer traders would stand to lose that a lot faster than a more experienced trader. So let's just get that out of the way. With that said, the most important aspect of your entire risk management strategy is actually going to be your position sizing. So again, this is going to be completely dependent on how much money you have in your account. So this is going to require some simple math on your part, but as a rule of thumb, what I like to do personally is I never go into a position with more than maybe 10% max of my entire account balance in total for one trade ever. And I never normally have a stop loss, especially if it's on spot. I normally never have a stop loss that's beyond like 3 to 5% of where my entry was, so that I can keep losses to a minimum and that I know that it's a calculated risk every time. Once you enter the trade, if you do take a loss, you know that it is a calculated loss and that it's not really going to affect your account overall that much, compared to going into a trade with no real risk management strategy. You're trading with money that you might need for rent, and your position starts going into the red, and then you start sliding the leverage up. It keeps moving against you, and then you get stuck in a hole. Well, why does that happen? Probably because you entered into a trade with no trade plan and no risk management strategy. Those are the two most important things that you have to do before you even get into a trade. Is you have to know what your triggers are, and you have to have a solid risk management strategy based on the size of your account. Now, with that out of the way, in terms of calculating position sizes and stuff like that I just explained, the next thing is going to be basically the tips and tricks that I mentioned before on how to utilize this leverage, right? So a lot of people have their whatever exchange that they're using on, in this case, BingX. A lot of people just leave it on isolated margin. They choose whatever their amount is right off the bat, and then they leave it there. Now, while there's nothing wrong with doing that, there are a couple caveats to this that could negatively affect you. For instance, if you enter into a trade, you've got a trigger, it looks good, price is sitting at support, it looks like you want to enter into a long, and you've got your isolated margin and it's on 10x for longs, and you enter into your trade. Well, you probably entered into that trade with the entire allocation for that one trade. Now, if you did this, there isn't anything necessarily wrong with that, especially if you're trading on a lower time frame, like a 5 or 15-minute chart, and you're looking to get in and out of the trade. I normally am looking for my positions on the 1-hour chart, and that's where I'm entering. But I'm normally making my trade decisions based on what's happening on the 4-hour or the daily chart, because I tend to like to leave my positions open for longer so I can maximize my gains when the trade goes my way. One of the most important aspects of this, if you do trade on higher timeframes, is splitting up the position. So this is also known as laddering. I do a lot of laddering with my trading. In fact, almost every position that I take, I use at least 2 to 3 entries, or sometimes even 4. And what I do is a martingale system where I'll enter with a quarter size, and then I'll double down on the next ladder, and then I'll double down against that on the next ladder. And then by the time my second or third ladder hits, it's my 100% of my position size that I'm willing to use for the trade. And what that does is it lowers my average entry or raises my average entry depending on if I'm going long or short. Now, again, this is just something that I do. I'm not saying that you have to do this. A lot of people are opposed to laddering because they don't understand how to split up their ladders, and they don't understand how to place them so that they can get their average entry where they want them. Some people just do not like their positions going into the red at all, and they don't want to see that. So they just don't ladder at all because they don't want to handle the drawdown. They just don't want to look at it. That's completely fine. But at the end of the day, it goes back to having a trade strategy and risk management. For me, laddering my entries is a very big part of that.
I already have a good trade set up. Please just get to talking about the leverage.
That's actually what we're getting into next, okay? This video isn't going to be super long, but I am going to tell you something that I do personally, which I think is highly underrated, that I never hear anybody talk about, not on YouTube, not on Twitter, nothing. I never hear anybody talk about this. And that is that when you enter into a trade, you don't have to start with leverage, right? So even if you're trading perpetuals and it's a leveraged, it's a leveraged product that you're trading or a leveraged pairing that you're trading, you don't have to enter with that 10x that I mentioned before where you left the isolated margin at. If you're entering into a new position, you can slide that all the way down to 1x, lay your ladders down, observe the volume, observe the price action, see if the price is going to go your way. And then what you can do is you can slowly add on size to that position. And if it does end up going your way, this is like the hidden secret is once it goes past your entry and that is in profit, or you're getting to the point where you're moving your stops into profit, that's when you can just move the slider up and say, okay, well, instead of 1x leverage, I'm going to use 5x. And then you take some profits, right? And then you can move it to 10x. Well, what does this do? While you're taking profits on these positions that have went your way, by moving that leverage slider up, you're effectively keeping your original position size the exact same while also taking profit. That is the real use for leverage, guys, okay? It's not, oh, let's enter a trade with 100x leverage and smash 100x. That's not the way to go about this. If you have a leverage slider on your exchange, with BingX obviously does, and over here you can see that it's obviously telling you all of the information that you need to know about, you know, your P&L, your open margin, what your maintenance margin is, all of these different things. It tells you right here. So while you're in your position, you can monitor all of that and adjust your leverage accordingly. Now, again, this is going to have a strong relationship to your risk management and your position sizing. If you go into a trade with 5x leverage and it's like 25% of your total account, you're not going to be able to reduce your leverage and reduce your exposure over time if the trade moves against you, because you're not going to have enough margin in your account to cover the actual position that you originally entered. I hope that that makes sense. And this is why I prefer to do it the opposite way, which is when I first enter into a trade, I throw down my bids or I throw down my asks, I put my ladders down, I enter with 1 or 2x leverage. And then when the trade starts moving in my direction, if my other bids didn't fill, I close them out, putting that margin back into my account. And when it moves in my direction, that's when I can increase the leverage and increase the position size to the size that I would have had, while also not really exposing myself to any additional risk because the trade is already a winner. Now, I know these talking head videos isn't everybody's cup of tea, so I'm going to keep this short. Basically, I want to sum up by letting you guys know that just because the slider is there doesn't mean that you have to open up your position with that leverage. My recommendation, especially for newer my real recommendation for newer traders is to not really use leverage and get your practice in on spot so that you don't have any increased risk to your overall trading while you're still learning. But for intermediate traders and those that have been trading for a couple years, you've got a good strategy, you've got good risk management, like I mentioned before, and everything is solid. Once you have those techniques, yeah, my big recommendation and my little secret that I still use to this day is I will enter the trade with very low leverage, 1 or 2x. And when the trade starts moving in my favor, that's when I can start sliding that leverage bar up higher while I'm also taking profit at the same time, basically offsetting the profits that I took and keeping my position size the same, so that as I continue to take profit, my position size is still the same, my average entry reduces, and then if the price starts looking like it's running out of steam, I can just close the position and that's it. Another benefit to this is that if the trade goes against you, those losses aren't going to be extrapolated by having high leverage when you first open the position. So if you open a position with 10x leverage and then it immediately goes against you, you're going to be a lot more underwater on your account than if you would have opened the position with 1 or 2x to start with while you're waiting for the price action to develop. All right, guys, that's pretty much it for this video. I hope that these tips and tricks really help you out. If you guys have any questions or comments, let me know in the description below. Again, there's also a link to our Discord as well as the BingX exchange, which I can't recommend enough. It's really awesome. I've been using it for a few months now, and it's awesome. I actually switched over from FTX to BingX because there's more pairings, and honestly, I just like the layout and everything better. Plus, they have on-demand customer service, which is great. But again, if you like the video, make sure that you drop a like and hit the subscribe button for notifications on future videos. And until next time, happy trading.